Welcome to the Well Off Podcast, where the goal is to motivate, inspire, and share success principles. I'm your host, George Masri. Mark Baltazar began his real estate investing career in 2015, focusing on single-family rehab projects, and then he shifted to commercial multifamily in 2018. He has since grown a portfolio of over $40 million in assets under management to date. He's the co-founder of Peak Multifamily Investments, which is a real estate fund management firm dedicated to helping Canadians grow their wealth through apartment building investing. In early 2023, Mark and his business partner completed the establishment of a private REIT, which is a real estate investment trust, for those that don't know, to enable eligible Canadians to grow their wealth. So on this episode, we talked about hiring a consultant in order to launch their REIT. So a little bit about that journey and how they got started, a brief explanation of the fees they collect, breaking down a recent 18-unit acquisition, and also why they avoid smaller markets, certain criteria they look for in order to invest in certain buildings. So I hope you guys will enjoy the episode. I just wanted to offer you, as a valuable listener, a copy of a report that we just released, which is the Multi-Unit Renovation Operations Order. This is just a simple document that we use when we are about to renovate a vacant unit. It breaks down certain things that we take notes of, certain things that we measure. So I think it's going to be really valuable to a lot of investors that own multi-unit properties. And you can download it by going to www.welloff.ca/report. There you go. I hope you'll enjoy the episode and looking forward to connecting with you soon. If you want to chat at any point, you can book a call on the website as well, welloff.ca. I'm here with Mark Baltazar. Thank you for coming in again.
Yeah, thank you. Appreciate it.
Last time you were with your partner, Mike. He couldn't be here because where is he again?
He's in sunny Aruba. So he's in a better place than we are in terms of like weather.
Yeah. Is he looking for a property there or just enjoying? A lot of people are looking for vacation homes nowadays. So
just a break. As real estate investors, I'm sure the eye is always looking for something, but he's there just hanging out.
Yeah. We were just talking about around the bay. So you just completed that. I think that's a 30-kilometer run.
Yeah, 30K.
30K, which is hard. I did a half marathon a few years ago, and that was really hard. And that's probably because I wasn't I ran a lot, but I didn't prepare the way I should have by changing my diet, or I don't think I even drank anything while I was running. I just went straight, never stopped, nothing. So I felt so sore for a week or two after. How was that experience for you, the 30K?
30K was... So I think I was prepared for harder. It's not easy. I did 20 a couple of months ago in Florida. Although the weather was the same, it was like 5 degrees when I did it in Florida, and it was about 5 or 6, maybe 7 degrees in Hamilton a few days ago, weekend. It was good. It's the most I've run. Everyone talks about, what you're familiar with, is that last kind of 10K. The hills, the steep climb. So I worried about that, but it was good. I mean, I think I did prepare for it. Running regularly. I did the 4x48 Goggins challenge a couple weeks ago. Yeah. That was hard. That was really hard. Because fatigue really kicks in, and your mind really tells you to not. What are you doing? Why are you getting up at 4 a.m., 12 a.m., 8 a.m. To run alone? I did it alone. So that prepared me. The fatigue and kind of going through that helped, I think, with this 30K.
For sure. And I remember when I was doing my half marathon, I think your body or your mind starts to question you really early. At least for me, it was at the 5K mark, it's like, okay, you got another 16 to go. Yeah. Do you really want to do this? And then at the 10K mark, you start to feel a little bit, I remember my ankles were kind of starting to feel the pressure of stepping all the time. And then I think at the 13 or 14K mark, my calf started giving out because I wasn't drinking, right? I was so stupid. I literally ran probably 8K with a dead calf.
Really?
Yeah.
Wow.
And it was so painful, but it's so true that you can just push yourself and just use your mind to get through those challenges.
That's why I even do it. It's not really the physical benefits are obvious, right? Cardiovascular benefits, health. You're running, it's good for you, right? maybe it's not so good for the joints and bones later on, who knows, but it's definitely good for you. But I like it, and the reason why I continue to do it is the mental challenge. Like I know the roadblocks come up, and I know when they're going to come up. So for me, it's like within the first 2 kilometers, typically, especially like when I'm training, the first 2, even if I'm doing like a 15K or even a 10K, between kilometer 1 and 2, my mind will be like, why are you doing this? You don't have to do this. Just kind of like, just chill out. Right. And then, if I set myself to like, let's say it's a 10K, kilometer, 8, 9, and between basically 8, 9 or so, when you're almost done, my mind will be like, you're almost done. It's okay to stop and walk now, right? And so you have to fight through that. And so it's the mental battle. And it's funny, like even in the 30K, again, it happened within the first 5, right? A little less so because you're surrounded by people. So I think being surrounded by a lot of other people gives you some of that extrinsic motivation to keep pushing.
Yeah.
But the last 5 was the same thing. Yes, you're almost there, but I've already done 25. That's pretty good, right? And so your mind starts, trying to convince you to slow down and stop. And I think the more times you put your mind in that scenario and beat it, right? Surpass that wall or break through that wall, the easier it's going to be next time it comes up. So I found for myself that it's now easier to just tell myself or tell my bitch voice to shut up and keep pushing. And so that's really why I like doing it. And it's because it's hard, right? It is hard. Whatever, distance you're doing, whether it's a 5 or 10, like everyone has kind of different challenges, right? So it's not about length. It's about facing as many of those voices in your mind as possible and breaking through them.
Oh, 100%. Even like 5Ks. I ran a 5K this morning, and it can get hard if you're really pushing yourself and you're trying to beat a certain time or whatever. Yep. So I love that about running too, but that's awesome that you completed 30K. That's a big accomplishment. Do you see yourself doing it again or doing something even bigger like a marathon?
I'm doing a 50. I'm doing a 50 next month.
Wow.
So
that's crazy.
Yeah. So this one's a trail. This one's a trail run. So it's I don't know the course yet. I know it's not. There's some flat parts. There's some hill. There's some terrain. It starts in the afternoon. If you don't finish earlier, like if you're not pro, you're probably going to go into the night. So I anticipate going to the night a little bit into the evening. Need a headlamp. So yeah, I'm looking forward to that. Again, I haven't run that far, nor did I ever even expect to even do 30 or even 20 or even 10. But now I think what's happening is I see these, or someone will say, "Hey, do you want to do this with me?" And I'm like, "Yeah, why not?" Like I don't really think too much about it. I just know that I want to continue challenging myself, and if it sounds challenging, I'll just commit, not think about it too much, because I know if I think about it too much, I'll convince myself not to do it. Yeah. So I commit, and then I have to do it.
Yeah.
Right? So the next one's 50 in a month.
Nice. Have you ever been on a trail, like run on a trail before?
I do. So actually, most of my running I do on trails. So I live behind behind or front of a conservation area. So hilly, small track. Roots, some mud, depending, like especially now in the
mud
spring.
is tough.
Yeah, your feet are wet, right? So
like when you're running, well, I did one trail run, and I remember the whole time I was running, I'm like, don't fall, just watch your step, don't fall.
yeah. Which is hard because you have to pay attention, and the longer you go, the more fatigued you get. Right, your brain gets fatigued, and that's how mistakes happen too, right? So just that in itself is difficult because your mind has to be on just to comprehend and step properly. So I enjoy that more than kind of road running, just because you're surrounded by trees. It's there's a lake and stuff like that. It's just a little more serene. For sure.
Yeah. Well, I think this does kind of tie into what we're going to chat about, which is usually real estate, and in this case too. I think that it's important because even like a lot of people that have coaches, their coaches often challenge them, even though they're like investment coaches or real estate coaches or whatever, they challenge them to do something that's physically scary. I don't know. Do you have a coach at this time?
We hired consultants well, I guess not really. Well, I guess similar to a coach. We hired consultants to help us figure out how to do what we, are doing now, and guide us, because we were spinning our wheels for a little bit. And so we did hire someone just to say that had done this before and kind of as in the space, in the capital arena, to just guide us. Because we, I think, we thought we could do a lot of things. This is kind of about the fund, starting the fund, right? Is that, we could figure things out along the way, and we did, but I think to get things done faster, just work with someone who's done it before and let them kind of, not even pave the path, but just shine the light on the path for you. So we're still working with this person as we continue to grow.
Cool. Is this someone from the States or local?
No, Canadian. And it was important for us that someone is here to understand. I guess just for context, we launched a REIT, and it's a new space for us because it's the capital markets, right? The capital markets and the investor dynamics are different. Something that we were not familiar with until kind of more recently, and so just that whole landscape, that whole environment was very new and foreign to us. And so we needed someone in Canada that understood securities, securities commissions, investing, capital markets, all that stuff in Canada.
Sure.
So
now, how do you go about finding this person? Like that must have been a challenge at one point, because it's not like you can find them everywhere. And I mean, they're just walking around and going to your local investment club.
No.
So how did you seek this person out?
So it was kind of by accident. So the first thing that we did is, so in this space, I'll back up and give a little bit of context. So in this space, as a fund or as a real estate investment trust, it's kind of part of it's private. So it's a private REIT. And so the private investment market is kind of also called the exempt market space, right? So it's, and what that means is it's exempt from certain exemptions. The prospectus exemption, which is kind of for publicly traded companies, or even real estate investment trusts. So first, I reached out to a bunch of kind of EMDs, or exempt market dealers, to get a better understanding of the process. Some were very helpful, right? In fact, they all provided some insight, and I wouldn't say superficial insight, but not enough insight for us to really dig our teeth into, okay, what do we do next? Nor did many of them provide kind of a consulting service. Finally, I bumped into one that actually did do that and did provide kind of consulting on, how to set it up. Is this even the right thing? That was the first question. Is this the right path for us, right? Because we had been talking about it for many years. Maybe even the last time we were here, we may have even talked about it.
I think so. Yeah, I think it was really fresh at that point.
Super fresh, still kind of just an idea in our mind, and we considered it for a year at least. So one of these exempt market dealers had someone working with them that also provided coaching and consulting in this area. So we hired him to work with us and just guide us. Yeah.
Cool. Because I mean, that's a really cool way to explore that as an option for a consultant. I mean, for me, I'm not there yet. I would like to be where you are at some point and start raising larger amounts of capital. But even for me, like, there's kind of limited amounts of people that can, I think, help with where I'm at, which is starting to get into apartment buildings and that kind of thing. I'm sure there are people out there, but sometimes I just wonder, like, what's the best way to seek these people out? Because I know there's a lot of coaches that will help on Airbnbs and flips and like some of these other strategies, but not that many people that know apartment buildings that well.
Yeah, it's an interesting thing. Let's look at social media, right? And I like to be careful too, because social media isn't the whole universe, but because people do spend, and I spend time on it, we market on it. So I'm there just ensuring that our brand is represented well, and you kind of see other stuff. So there's a lot of coaching programs and stuff available there, right? And so there's a lot of options, but I think what's happening is there's a lot of options popping up, right? And I think people just have to do their due diligence, right, on who it is. Do they have a track record? Have they done this before? How long have they been doing it? And also, are they doing it right now? Like that, to me, that's the key. Have they been doing it for a while, but are they doing it right now versus even, doing some, if they were active a year ago and not so active right now, there's a big difference because what's happening right now is very different than 12 months ago, as everyone knows. Yeah. Like the stuff that we're doing now, like the finance, like we're in the process of 3, potentially 4, and the potential 4th one is just determining if it's the right time, refinances, right? As well as an acquisition. And I could tell you that the financing dynamics, as anyone could imagine with interest rates, is very different than, a building we closed in August. Sure. Right. So, if you're looking for a coach, they kind of should be fairly active, right? Because it's very different.
Sure.
I'm sure coaches can probably teach you some process along the way, but from like start to finish to closing a deal, financing, finding the right lenders, they have to be active, right? Because things change so quickly, or have changed fairly quickly over the last 12 months.
It's kind of like saying, comparing that real estate agent that was selling a home back in 2021 when the market was on fire and you didn't even need photos at the time.
Just put on MLS.
Put it on MLS, put the address, 100%. No pictures, and you're going to get over asking versus today where, you can't really get away with doing that as much.
Yeah,
so
you have to be skilled as a realtor and a marketer to get it in front of the right people.
Yeah.
Totally. So I think there are, there's probably coaches out there, but that would be one of the things that I see that, you start to ask, are they actively doing deals right now? Because it is, that right now is different.
Yeah.
Right now is different.
We'll get into like some of the stuff you're working on today and recent acquisitions and all that. But just in case people don't really know your story, maybe they haven't heard you anywhere else, do you just want to give a bit of background about your real estate journey? I know you started off flipping, or you were flipping actively at one point, and then maybe just tell us a bit about all that.
Sure. Yeah. So I started in 2015, and I started with flipping. And actually, the intent was to wholesale. I took a program, like a weekend seminar from a company in the U.S., learned kind of the process, right? Flipping, wholesaling. It was more about, it was actually, they taught flipping, wholesale. They taught a few different strategies. Wholesaling was interesting to me because of the ability to generate cash flow. At the time, I had a job, I was a partner, a co-owner in a consulting firm. So that took up a significant amount of my time. Was consulting with bigger brands, global consumer brands, which was cool work. And so I started to dabble in real estate on the side. Did some flips over the years. I don't know what year it was, maybe 2017, late 17, early 18, probably late 17, acquired 2 apartment buildings with Mike, as well as another partner, and that kind of started the apartment building journey. Did some flips during that time, but started to kind of wean off the flips and start to focus more on the apartment building side. And so kind of been focused on the apartment building side. Do have some buildings kind of on our own and a number of them with investors. And, a couple of years ago, we decided to continue scaling it, built kind of the brand, Peak Multifamily, to create a brand around kind of what we were doing. My background is marketing and branding and brand strategy. So I kind of knew the dynamics of building brands. So now, we're essentially in an asset management firm or investment firm where people can invest passively with us. It's not for everybody. It's, for people that are looking to stay active and want to really be part of the operations of investments, apartment buildings, then they can learn and do it on their own. This is for people that have 9-to-5s, they're professionals, they're busy, they understand or at least want to be exposed to real estate or have real estate in their portfolio. Then that's who our clientele is, and we can do that now through a real estate investment trust, which also accepts registered funds, which is one of the big benefits.
Yeah, that's awesome. So I see that you went from full-time job, flipping on the side. I think you've left your job, obviously.
Yes.
You left your job a couple years ago.
Yeah.
So doing what you do now, you're building wealth by owning these apartment buildings,
Mm-hmm.
but this is like the common thing. How do you get by?
Yeah.
But with like you can't eat your wealth. Or whatever that expression is. So what is it that you're doing in order to get by? Are you able to survive from the cash flow of these buildings? Or I know you have your real estate license now, so are you making a bit of income that way or other streams of income?
So yeah, the real estate agent side, that I'm not really active in that. I got that really to help kind of people with apartment buildings when needed. I have a flip on the market right now that I'm not very active in flips, but let's say one or two a year. If I see something that's kind of, really juicy, then I'll jump into it. It's acquisition fees, right? So in acquiring these buildings and running these assets, we get paid a fee, right? So acquisition fees. Now the fund will also provide fees as well. That's just kind of starting up, or the REIT will start doing that. When I sold the other business, that generated, some lump sum because I sold part of my share, right? So that helped me for a bunch of years. Had flips prior to this that was able to bank some of that capital.
Yeah.
This is my sole business, right? This is like the investing side. So I'm kind of not doing anything else. And it's fully focused on this. And so it's fee-based, right? And part of kind of going into the REIT does generate fees on an ongoing basis, but they're performance-based fees. So the investor has to benefit first before we benefit. So it aligns our goals with with passive investors.
Right. So it's not like not really like a property management type of fee. It's more based on maybe setting certain goals, and if you guys reach them, then you get to take these fees.
Yeah, so it's asset management, right? So based on the value of the fund. So as the fund grows, right, the fees also grow, but as the fund grows, then the investors are benefiting. And there's a performance fee as well, and that's based on any returns beyond what the target is, then we get paid a proportion of the profits or the equity. So it's kind of like JVs, for example. There's like an equity split, like a 70-30 or a 50-50, right? So we have a similar type of structure, but only after the investors generate a certain return do we get paid. So that's why it's called a performance fee. So we only get paid if investors perform. That's kind of called the performance fee. And then an asset management fee, which all funds have, is a percentage of the total value of the fund. You get a fee.
Right. So just maybe high level, if we were to give an example of that performance fee, let's say you acquire a 100-unit building.
Yeah.
And you maybe set a goal to like turn over, 10% of the units in year one, or I don't know, that might be super high or something, but let's just use that as an example. But you end up turning over 12 units. So you exceed the expectations. Then in that case, you would get kind of like an excess fee for your performance, right? Is that sort of?
Kind of. It's 70-30. So basically, so we also have a hurdle rate in there to complicate things a little bit more, but it's to the benefit of the investor. And most REITs that at least I'm familiar with don't have this hurdle rate. So basically the first X percent, so in this case 6% goes to the limited partners, the investors. Then it's split anything beyond that 70-30. And so as long as they achieve 6 plus, anything beyond that is split 70-30. And so 100 unit build profit wise. So like if there's let's say $100 in profit at the end of the day, then 70% of it goes to $70 goes to the investor, $30 goes to a management, although it's not even 30 because they get the first. So they would get $6 and then 70% of the remaining. So it's actually less than 30% to management when you do the math.
So are you saying it's based on cash flow then? I know you said profit, but I guess
no, it's based on valuation. The value.
Okay.
So it's based on valuation. So so there's a third party that measures the value of the assets. Cash flow is part of it, but it's more about assets minus liabilities.
Right. Okay. So that's an interesting thing. Like I don't know too much about REITs and whatnot, so it's cool to hear that, and it's really cool that you're actually doing it, considering where you were a few years ago when I first met you. Right. Who would have known that you'd be starting kind of your own fund? Why don't we dive into what we were talking about a bit earlier, the impact of higher rates? So. First of all, if you don't mind me asking, how many acquisitions are you going through a year for apartment buildings? So maybe let's say over the last couple of years.
Yeah. So let's say from 2020, I think we did 3. 2021, maybe 2. 2022, 2.
Yeah.
And we have one under contract right now that will close. I think this year, so into the fund will roll in 2 buildings from our current portfolio because they're at the right stage where there's still a lot of meat on the bone, and we don't have to go searching. It's kind of, we already have it in the portfolio, so we'll roll it in. And then we just went on a building in Orangeville, which is a good value add, and that will roll in. I think we'll buy another 2, 1 or 2 depending on size by the end of the year. If we can acquire, 15 to 20 million in the next, let's say 2 years into the fund, that would be good. I think that would be a good kind of flow, and then it'll grow from there.
Yeah. So if we go back to 2020, 2021, let's say there were 4 or 3 acquisitions during that time?
Let's say 4.
Okay.
Let's say 4 between those 2 years. Yeah.
Rates were, even on the commercial side,
Yep.
at that time,
Cheap.
what, like in the 3s?
So depends how you look at commercial. So
Yeah.
so long-term financing, so like CMHC was in the 2s,
In the
sub
2s.
2s actually, some are sub 2s. I mean,
Wow.
I think we locked in on a 2020 building. We purchased it with CMHC out of the gate to 2, exactly 2, maybe 2.1.
Which is usually a bit uncommon, right? For you to like purchase with a CMHC underwritten mortgage right off the bat. Would you normally get...
We did it twice.
Yeah.
We did one 2020 and 2021. We purchased CMHC right out the gate.
Right. So for the other 2,
Yeah.
you would have gone just with like a standard commercial mortgage at that point, right? Or was it private funds? Or?
So we do, it's like a bridge mortgage, a bridge loan. So I wouldn't say it's standard commercial, because a standard commercial would be like a 25-year AM, principal and interest type of loan. This is bridge financing. So typically, I don't want to generalize too much, but typically it would be just interest only. And so the lender knows the strategy. They understand that what we're buying is underperforming. The debt coverage ratio is fairly low, right? Given the pricing and given where the income's at, that's the opportunity.
When you say fairly low, are you saying below 1?
Below 1.
Yeah.
Yeah, below 1. And so it's negative, right? So it's negative cash flow out of the gate. And so with that, you do have to have reserves, and you have to show reserves, right, in your account to cover the negative. Or what they'll do, and what they're definitely doing more now, if you use that type of financing, is they'll have like a reserve, like a holdback, right? And so back then we were buying stuff with an interest rate at around, I'd say it would have been prime plus maybe 3.5, right? So you were in the 6s, 6.5 ish. Now you're probably, depending on who it is, you're 8 to 9.5. Right.
Which is still kind of the same, right? Prime plus 3 roughly.
Yeah, about, yeah. So, but that's just really expensive to carry. So our most recent, so the one that we will close on in June or July, we're likely not going to use that type of financing. And we may just go CMHC out of the gate, debt coverage of 1.3. You need a little bit more equity. It's a little bit more of a safer play. You don't have to kind of worry so much about unit turns. It's just much more stable. It cash flows right out of the gate. Yeah, you have to put more equity. So I think that's how things have shifted, at least from an acquisition standpoint, is you're going to require a little bit more equity, or there's a significant risk if you take on that kind of debt right now. Yeah,
for sure. At the time when you purchased these 2 buildings with a prime plus 3.5 bridge loan, what were you anticipating the financing would be after you've turned over some of these units? And like, what was your timeline for that?
Yeah. So we thought the financing would be better. We thought it would be better. Like one building, we actually did refinance. We did a bridge to bridge because there was so much equity in there. We basically, because of the rate, I wouldn't say lost out, but we pulled out about $900,000 less than we thought we were going to.
Yeah.
Now we turned the whole building pretty much. We turned 16 or 17 at 18. So it's
Wow, that's
pretty significant turn.
And how much time?
That one was acquired in 2021, January, right at the beginning. Actually, we did 2 in January 2021. January 2021, August 2020. So about 18 months, about 19 months.
So like almost one a month you're turning over.
Yeah. There was a big chunk and then nothing, and then a big chunk and then kind of a rush to the end, basically.
Right.
And so that one, again, because of the rate increase and because we have to now at that point maintain some sort of debt coverage ratio, we pulled out $900K less than we would have. Now, because we turned a lot, it was still good. We were able to kind of give 75% of capital back, right? Capital repayment. So still very good, but not 100% BRRRR, which those are tough now. And
well, especially in 18 months. Yeah.
It's a short amount of time. And yeah, so I think the days of the 100% BRRRR are dwindling, right? There's not many that, you'll probably find that can do that. Even if it's 100% vacant, you still might need to keep money in the deal. But at the end of the day, that's what multifamily is for, right? Like, multifamily is long-term. The fact that we were even able to do that during those kind of 2-year period, is amazing, but that's not really what the asset class is meant for.
Right. Yeah, for sure. I think there was this expectation that everything was going to be 100% BRRRR. People, made it sound like the greatest thing ever, and everyone was doing it, but the market was also appreciating. Like I'm talking about on the residential side, and then also rates were super low. Yeah. So when you're talking about a much larger asset and much more money involved, if the rate goes up by 4%, then it has a huge impact.
Huge impact.
Yeah.
Yeah, and I think you still see the remnants of that kind of thinking. And same thing on the commercial side, or the multi-residential side, is there's still people that kind of are looking for that, and they might find it, right? Like they might find it, and it might be out there. It's going to be very hard to come by. Yeah. So I think it's our job, kind of as investors and thought leaders in the space, to educate people that it's possible, those perfect BRRRRs, but you could be waiting a long time. And while you're waiting, what's your money doing?
Yeah, it's a different way to look at things and to think about it, for sure. As an investor, when you're entering into that asset class, then you can't think like a residential investor. You've got to totally shift. So 100%. How did your investors feel about the results, given that they were basically pulling out $900K less than you originally thought?
Well, they got 75% of capital back, right? So that's a good number. And so typically the plan was never to pull at 100, right? Is to keep money in. I think during that time, 2021, the rates continue to go down, I believe, after that, right? So our pro forma, I think we ran our pro forma at probably a 3.5% rate to take out.
Yep. Right.
It could have been 2, like we could have done it at 2 if we did it at, in 2021 at that point. And so, also it's our job to educate that things change. And I think because things change for everybody, right? People understand. Also, the investors that we were typically working with, and typically just in multifamily, they're longer term thinking, right? So, subtle changes like that, like again, it's screening in who you're attracting. We're not attracting people that kind of want things turned around in 18 months or 20 months even. That's more speculation.
Sure.
That's way more speculation versus investing.
Yeah. So if we're like talking about why you would go with a CMHC loan up front, CMHC underwritten kind of mortgage, versus this bridge loan or other financing, and then rolling it into a CMHC mortgage later on, I guess the difference is if you're going with CMHC from the beginning, you're pretty much locked in for those years, right? You're not really going to be able to pull out any equity for like the term of the loan, which would generally be what, like 5 years, right?
5 years, yep.
So the investor's money is locked in. But if you go with this bridge loan at a higher rate, then you're saying within generally, I'd say like 2 years or so, maybe 3 years, you're able to refi it, get a lot of money out, and that's the benefit for the investor, correct?
It is. You're just dealing with rates that are 9% right now.
Yeah.
Right. So, on $5 million plus mortgages, that's a hefty monthly, right?
Sure.
So, now we've done it. We've recently did it. Now we did it because we also acquired with vacancies, right? So there's always like a nuance to the situation. I think if you're acquiring a building, and it's fully tenanted, and you're relying upon tenant turnover to pull out that equity, that to me is a risky proposition. Like we don't underwrite that way, and it's kind of even scary to underwrite that way.
Yeah.
Because especially now, as the gaps between current rents and market rents continue to grow, people aren't looking to move out from paying a lower rent, paying something higher.
Yeah. Even if they're getting offered 15 grand or whatever number
it is, right? Like, it could go higher. And people just don't want to be displaced, right? We, an acquisition that we just made in August in Mississauga, that had seven vacant units, right? So right out of the gate. Now you also pay for the vacancies to some degree, right? So you're paying for that. You're paying a little bit of a premium.
Yep.
It's not like the appraiser appraises those things as zero income. They're appraising it at market, but market based on the current condition, right? We renovate and elevate the value of the building. So that we were comfortable doing these types of bridge loans because we know we're turning 7 units for sure, right? Which we've done. We've done 6 actually already on that one. So I think there's a time to use it and time not to use it. I think, and lenders are also being more critical of the business plan, of the operator, the exit strategy, right? So they're always looking at the exit, but I think they're being much more critical about show me how you're going to take out my debt, right? That's at the end of the day, that's what they care about. How are you going to pay me back in 24 months? We underwrote a deal recently that we sent to a lender that we've used before. And they said, yeah, this works for us. And this was 23 units, 23 unit building. And they said, you'd have to turn 16 units for us to make this work. 16 out of 23 in 2 years, that's
almost impossible.
You can do it maybe, but I don't know, way too risky for us, right? That's just a lot of, it's not the work, it's just a lot of uncertainty. Yeah. It's not guaranteed, right? And to do that many in 2 years, like we're basically projecting those numbers over a course of 5 years, right? Just to be somewhat conservative. And if we don't get those turns, then, we're in markets where rents continue to appreciate, right? We're just kind of in more densely populated markets. So you kind of have a little bit of that rent rate growth beyond the allowable increases. So that's what lenders are doing. That's what they're looking at. They're underwriting to make sure they can be taken out at the end. Yeah.
And I know you've already sort of touched on this, but in what way has your exit strategy changed now when you're underwriting a deal, knowing that there's like uncertainty with the rates, maybe they will continue to rise? Are you adding to the rate at this point based on what today's rate is when you're projecting into the future, or what's the strategy with that?
So our takeout rate is just higher, right? So right now 4.5 to 5. Right. So if we were to lock into something today, it would be 4.3.
That's a CMHC.
CMHC takeout. Yeah. Right. So that's, look at the Canadian marketable bonds, so the CMB plus a spread. We talk to our lenders, closely on a regular basis just to see how, anyone can see kind of what's fluctuating, right? Then they add a spread to that. Right. So, our conversations with lenders is kind of how do we shrink that spread? And you can shrink it, based on a few things. One, your relationship with them is kind of first and foremost. Also, how large the loan size is, right? So the more we can, and that matters, right? I think at those loan sizes, even like a 10 bip decrease matters on the takeout side.
Sure.
So underwriting, we're just underwriting with higher rates, right? And if it works, cool. So deals are being scrutinized a little bit, more, and that's why you have to buy, at prices that are probably a little bit lower than they were a year ago to get that proper takeout.
Is it risky, in your opinion, to bank on getting a CMHC loan, considering that there's a massive difference between CMHC and like a conventional commercial? Because CMHC can go up to 40 years. I think in some cases even more with the MLI Select program.
Yeah.
Whereas you're getting a 25-year on a standard commercial, and the rates are also higher. So is that a risk at all to you, or you feel pretty confident you'll be able to get it?
So we'll talk to our lenders beforehand, right? I think what we're buying, again, big, not big cities, but strong markets, purpose-built, concrete construction. We financed with CMHC before. We'll also have our lender look at it too, right, before kind of as part of the DD, and just to see if there's any flags. But we haven't had any issues, with them saying, no, we won't fund something like this. At the end of the day, it's going to be based on the financials, right? They'll fund anything, kind of, right? I don't want to generalize, but what they're going to look at is the operator track record. Can they do what they say they're going to do? But also the big thing is debt coverage, right? So is the debt coverage at a place that's their protective mechanism,
and the location as well, as you mentioned.
Matters. But location, they'll adjust that. So if you go into a smaller town, for example, they may still fund it, but your vacancy rate assumption just might be a little bit higher.
Sure.
Right. So if it's in Toronto, Mississauga, you might have a vacancy rate, or there are some assumed vacancy, even though it's probably not going to be vacant. You're still going to have like a 1 or 2% vacancy rate. Whereas if you go somewhere else, maybe Sudbury, and I don't know what the vacancy rate in Sudbury is, but I'm just going to, by example, maybe it's 3 or 4 or 5, right? So they bake in their risk tolerance with that as well.
Now, speaking of smaller markets, is that something, like, what are your thoughts on that? Is that something you guys explore, or do you just stay away from really small markets? I'm talking about towns that are like, 40,000 or less, or even say 20,000 or smaller.
Yeah. We typically have stayed away from it for a couple, although we just went from in Orangeville. Orangeville is probably in around that mark. But we made an exception there because rents are strong. The rental market's good. It's close to other cities. It's a hub for other larger centers such as Brampton, Mississauga, and such, right? So, and they have kind of a local transit, population's growing. So that, it's not that it's a rule of thumb, but we made an exception there because we know the market really well, and also larger players that we know and are connected with are also there too. So we felt comfort, and they've been operating there for years and have a good business. Smaller markets such as those, like 10 to 20,000 in population, do worry me. Again, our business is based on, so if you think, any business is based on customers, right? The number of customers is just very small, right? So you're pulling from a customer base or universe that is smaller. Now, so the trade-off is you're buying, your cap rate may be higher, right? So cap rate is a yield. Your yield may be higher. So your cash flow is probably better. In fact, it should be better. But cap rate is also a measure of risk, right? So the higher the cap, technically, right, it is a riskier investment, or because it's a riskier investment, your cap rate's higher, right? And so I'm not a fan right now of those markets, because when there's economic turmoil, right, and when stuff starts happening, I think people start to go where the jobs are, right? So go where the jobs are, go where the transit is, go where there's infrastructure being built. You do pay a premium for it, right? So, paying $300 plus a door in the center of Mississauga, you're paying $300 plus a door, but it's also the center of Mississauga. It's not going anywhere, right? Like, infrastructure is being built for the next 30 years, right? It's not moving. You go to, and I'm not going to kind of pick on a specific town, but like you go to Timmins, right? Or you go, Sudbury, I think is probably, strong. We've looked at Sudbury. Sudbury's, good. If you go to like these smaller towns, any little shock wave, like one employer moves, like your business is impacted.
Sure.
Right. So, again, because multifamilies, our proposition is multifamily, the investment is long-term, it's stable, it's where you can kind of, have peace of mind in the investment. We have to go into markets that provide that.
Yeah, for sure. And also, not that this is necessarily a huge factor, but if you are in like a town of like 10,000 people, then you probably don't have as much selection with tenants. You're not,
100%.
and that's a big deal in Ontario where it's not easy to get people out. So, it might take you a while to find that right tenant. You might have a vacant unit.
Yeah.
Even though the vacancy might be low and you might get offers from tenants, you want to probably be selective, right? So if we go back to that example of that building where you turned over 16 units in 18 months, can you kind of give us a breakdown of how you did that? Like, what was the procedure? Was there a lot of cash for keys involved? Was it something else?
So there was some cash for keys involved. The first part of it was poorly managed to begin with, and just very, very laxed management. The owner was fairly lax. So when we came in, so the first thing, I think there was already 4 vacancies out of the gate. So that helped, right? Then as you start to construct and start doing renovations, you try to keep the noise and the dust down as much as possible. But at the end of the day, you're in an apartment building, right? Noise travels and such. So then you start to get natural turnover because of that. Then we had a conversation with people. It was like, listen, the renovations are dirty, dusty. You see it. We'll happily help you find other places, right? So we had our leasing agent kind of search, and that helped. There was a couple of families in there that took us up on that offer. We helped with moving costs and such, and they moved to a better building. The building was really run down, right? So it didn't really kind of take much to get people into another nicer place. And then we provide financial incentive for those who kind of wanted it. Those who didn't kind of stayed. But eventually it's an area where it's transitory. So turns were happening fairly naturally. But yeah, we did provide financial incentive for those that wanted to, that considered it. And it was also during a time where the gap between, although the current, what people were paying was fairly low, but it's not like it is today, right? The market has grown significantly, or at least rent rate.
The spread
is much larger than it was even a year ago, right? So a combination of all those things. And typically that's what we'll do. We'll let people know, hey, listen, here's what's happening. Just so they know there's renovations going on, there's dust. And some people just don't want to kind of be in a place that's where that's happening.
Yeah. I find that kind of surprising if they're paying way under market, because I don't know, I feel like a lot of tenants just want to stay to live as cheaply as possible, but I guess that makes sense. If the renovations are going on for like 18 months straight, then maybe, because you're doing a new unit all the time. I don't know if you were doing probably doing a bunch at once, but like as the units turn over, there's new construction happening. So they're just constantly hearing noise and all that. So
it's a pain. I mean, you do what you can to kind of reduce it, right? And not be a nuisance so much, because again, people are living there. But this was also during a time too, typically when you kind of do the work, right, the 7 to 5 or 7 to 4, no one's home. This was during a time where everyone was home, right? So it made it even worse, right? So I think now is a little bit different. You're doing construction, people are at work or whatever, they have options. At that time, people were at home, right? And fewer places to go to kind of get away from that kind of stuff. So I think the combination of all those things, allowed us to do that.
Last time I had you on the show, we were talking about like the renovations that you guys do, and you were saying that you guys are doing like really high end stuff for the most part, ductless mini splits, all that. Has that changed at all given the environment and maybe just inflation, things becoming more expensive? The cap rates and the interest rates coming up and all that, or are you still kind of doing the same?
Yeah. So I'd say we're definitely not the highest end. There's definitely people doing way higher end than us. We're providing, I think, condo quality, and improved living space for sure. I know if there's like extreme high end, I'd say we're probably middle ground somewhere. Has it changed? The model's the same. We're still doing the same type of thing. Mini splits, so the cost for those has gone up. It's almost doubled. We continue to put those in. more so now, or at least we're putting those in because of the MLI Select program, right? So program which encourages, swapping or improving the energy consumption of the building, let's say, right? So as we move from natural gas boilers, over to electric, these mini splits are electric. We're looking for different models that fit that profile. So yeah, we're still same thing. Our costs have gone up.
Yeah.
Right. So our costs have gone up. How much? Maybe 15% ish, at least.
Yeah.
On those units. Now, since over the last 12 months, we've looked at each there's we have a bunch of renovations still going on right now. Some units we've just done paint, maybe swap the kitchen, and we can still get similar rents. Sure. Right. So we're being a little more selective in terms of which units get the full. Full Monty upgrade. Some of them are still in pretty decent condition. So paint, maybe swap out the kitchen counters, maybe cabinets, and that's good to go. We just did that in a few buildings and we're getting similar rents. Yeah. It also improves just the speed of turnover as well.
Sure. Yeah. I mean, I've been seeing that too. Like there's some other investors that I know that always talk about like just quickly doing it, lipstick, everything. Although in some cases you can't really do that because there might be plumbing issues or whatever else.
Yeah.
So,
but
that makes sense. Can you just maybe quickly talk to us about like an acquisition you're working on? Maybe just run through some numbers just for the people listening in case they are interested in learning about what you do to make sure you're getting into a good deal.
Yeah.
I know it's kind of hard because it's right off the top of the head, but
we could talk about the one we closed just in August, right? Sure. That's probably the freshest because it's closed. So that was an 18 unit in Mississauga, here, Ontario, in Dundas, like good location, 6.4 million. So I don't know what that works out to, like 350-ish or something a door. Again, so kind of going back to kind of premium markets, that's. It's hefty compared to other markets, but you're also in the center of Mississauga. LRT's being built. You're, a kilometer away from Square One. You're like 500 meters from the Cooksville GO station. So like you're at the center of kind of everything, right? So that one, 7 vacant units. We've turned over 6. Interestingly enough, so by way of example, in terms of how hot the rental market is, so I believe when we did that, so if we closed in August, we would have put that under contract probably, I don't know, April, May or something like that. So we would have started running our numbers in February, March, let's say, right? Or something like that, kind of doing our underwriting. And so that's a mix of 2 bedrooms and 1 bedrooms. Probably, I think there's like 6 or 7 2s, and then the rest are 1s. And so our 1s, I believe, without having the numbers in front of me, we would have projected, I don't know, maybe like 1,850 or so, 1,800 or so 1-bedroom rents. And then our 2 bedrooms, we would have probably said 2,100 or
seems kind of low,
something like that. Yeah, I mean, we're competing with condos,
right? That's
then. Right now, we just got 2,150 for our 1s, and we got 2,450 for our 2s.
Yeah,
that's what it is right now. Yeah,
that's a huge jump, and that obviously impacts your
the valuation, right? It also counters the effect a little bit of the interest rate increase, right? So we had interest rates increase during that time, but our valuation, so it impacts the valuation, and I think long term that's good, right? Like obviously, I mean it's it's good for the NOI. And again, it's an example of, being in a strong market, you're going to get demand, right? And, with immigration, what's happened with immigration, right? Most people are coming to Ontario, right? As much as there is some migration into other provinces. At the end of the day, most people 75% of people are probably coming here to the GTA in and around. And so it's, it's a reflection of the demand.
When I look at these numbers, like, you said 2,400 for a 2-bedroom?
Yeah.
2,400, that's like, roughly almost 30 grand a year for rent, almost, right?
Yeah.
I find that pretty amazing that there's so many people that are able to pay 30 grand a year for rent. I know it's probably like 2 people that are working and paying this off, but that seems pretty crazy to me that there's so many people out there able to do this.
Well, what's the alternative, right? Like, where do they go? Because of interest rates, yeah, sure, single family housing prices have come down, but your qualification's still tough, right? So, like, I was reading a report this morning from CBRE, and again, don't get me, like, I don't have the exact numbers, but like, to qualify for a single family home, right, in the GTA, you need like 220, right, detached, like 220 combined income. A semi, you're probably at like 150 to 160, maybe 170 combined income, right?
Plus savings, like plus enough for a down payment.
Plus savings, right? So like that's pretty significant, right? And so the alternative is rent. And so, yeah, I mean, and so, with the median income kind of in the GTA about 100, it's not 100, it's about like 95 or 96, right? That's the alternative.
A third of your income is going towards rent.
Yeah.
Crazy. So sorry, you said the acquisition price was
6.4.
6.4. And then what are you anticipating the value will be after you've turned over these units? Or all 7 vacant units?
When we're done, this will be an $11 million building. The 6 right now, I would say, I don't know. Let's see. I would say we're probably close to 8 million now.
Why were there so many vacant units, by the way?
So we negotiate a couple things. So So there was like 2 or 3 when we saw the building at first. The broker, again, in the commercial space, if you're working with a specialty broker or someone who's familiar with commercial, they understand that there's value in vacancies. I would imagine that the seller was coached to basically not fill those units, right? So any turns that would come up, don't fill them. The other thing that we said is in our contract that we would pay is if anyone left after we've gone firm. So once you go firm, the seller still holds the building for, let's say, another 3 or 4 months, right, until closing. They're operating. They have to operate it, as they've been operating it until we close. Now, if units start turning over, they're going to want to fill those units because that's money out of their pockets. So what we typically do is say, listen, if there's any units turned over, we'll pay for that rent. We'll pay for the monthly rent until we close, right? So that they're not out of pocket, but the value for us is that
it's worth it.
So I think there was like 3 or 4 where that happened.
Really, that's a lot during a 3 or 4 month period.
Yeah.
So again, you guys got a little bit lucky on the vacancies, right?
Yeah,
because you were probably running your numbers with just like three vacant units.
We may have done 4. We may have done 4. I forget exactly the numbers. It ended up being 7.
That's amazing.
But part of why this was an appealing building is we knew how it was managed. It was held in the family for like 30, maybe 25 or 30 years. There were definitely signs of being tired landlords, right? And people just don't put up with that, right? Yeah. They're not going to pay for that kind of stuff. When you're surrounded, when you're in the market where there's a lot of options, you're not going to put up with poor management.
I think I used to know someone that lived, and maybe not in the building you own, but definitely in an apartment building in that area. So I think I know the buildings. There's a bunch of them, right?
There's it's space. There's a road. There's a bunch of there's new developments going up now too. There's a lot of activity in that area right now, like a significant amount of development going on. But there's a road with a bunch of different buildings, like low rise, high rise. Yeah.
Cool. So that's awesome. So 6.4 million, 7 vacant units out of 18. You guys have already renovated 6. You're getting way more rent than you thought for the 1 bedrooms and the 2 bedrooms. And the ARV you're looking at of 11 million. But once again, this isn't necessarily meant to be a perfect BRRRR. The money is there
absolutely not.
To basically provide a healthy return to the investors over a long period of time, right? And that's kind of the mindset you have to have if you're getting into the space.
Yeah. I mean, I think there's, for those that need like a significant amount of cash flow or their money out quickly and be very liquid, there's other ways to invest, right? Like this asset class is meant for long-term capital appreciation, generational wealth building. If you don't have the stomach for volatility, this is probably good for you too, right? If you're in, I looked at a mutual fund statement that I have, right? It's been in there for years, right? It dropped in half. My value dropped in half from 2021 to 2022.
Yeah.
if I was older and was going to rely upon that, that would suck. That would be crazy, right? And so if you don't have the stomach for that volatility, I'm not saying that stocks are bad, right? They're just whatever. They do what they do. Right now, we're kind of in a volatile time. This is it's stable, right? It's boring, right? It's, it's a good space because there's demand. Immigration's coming in. Like I was on a webinar a few weeks ago with some of the larger players in the country, some hedge funds and the largest asset management and apartment building owner in the country. And they're saying that there's more capital now coming into Canada to this specific asset class because of that, right? Because of what's happening everywhere else. It's just stability. It's not just preservation. You're going to have some growth, but it's stable, right? It's stable. It's going to do what it's doing, kind of what it's been doing for as long as anyone can remember.
Yeah, and just to compare it to somebody who might be investing in smaller, like say they're doing duplex conversions or whatnot, they might get a higher return doing that than investing in an apartment building. But again, this isn't to get the highest possible return. It's more for stability, good returns over a long period of time. Yeah. So it's just, a different class.
It also depends too, right? Like if you're doing it on your own, you're going to get higher returns. You're doing it on your own. You're keeping all the profits yourself, right? So if you want to be active, you'll make more money. Probably more, it's probably risk of making mistakes too and all that kind of stuff. And you have to have the time. If you're investing or JVing, maybe, I don't know what the returns are for duplexes, but it's also duplex. I think now we're in a good place because rental demand is high, right? So it's still the same dynamics, right? The risk of vacancy is probably low, except when one person in a duplex does leave, because it happens, then your income gets cut in half.
Exactly.
Pretty much, assuming it's the same, right? So
speaking of high rent, this is totally random, but not really related to what we're saying, but rent is so high right now that I actually got multiple offers for a basement in Welland of $14.95.
Really?
Which is so crazy.
How many bedrooms?
It's a 2-bedroom. It's a big basement. It's like 1,000 square feet.
Yeah.
Really nicely done and everything. But just to think like in Mississauga, you were projecting $1,800 for a 1-bedroom in a prime location. And like you can get $1,500 for a basement. It's just, insane.
Wow. That's good.
Yeah. So I think we covered a lot. Do you feel like there's anything else we should touch on or?
No,
there's so much.
Yeah, we could probably
topic.
Go for a whole day.
I think.
No, it's great. It's good. I mean, I think the main thing is there's a lot of investment strategies that people can tap into. I think the one thing that you get asked the same question, I'm sure as well, like what should I go into? And it's very personal, right? I think the first question people should ask themselves is, what do I need it to do for me, right? And maybe you don't have to put all your money into one asset class. You can spread it around, and stocks and bonds and other forms of investment also play into that. But like, what does it need to do for you? Like, what is the goal of that piece of capital? Is it long term? Does it need cash today? Like, what is it? So that's the first question. And then that also helps to determine what market, what strategy, how much time do I have? It should be passive, active. So
the just like, because I started doing a bit of like stock options trading probably a year ago now. Not too much, but I saw obviously a huge dip in the market, in the stock market, and it just made me realize I'm helpless when it comes to stocks. I can't change.
Yeah, me too.
Like I can't change how the company's performing and what the stock price is, but you can do something about owning the real estate that you own. You can force appreciation. There's like, you can add a unit. You can, there's all sorts of ways to add value to a property, and you have so much more control, which is the really cool thing about it.
Yeah, for sure.
All right. So just in case anyone's interested in learning more about your fund, where do they go to find out about that? If you can share that.
Yeah, sure. peakmultifamily.ca. The website has all the stuff. We have, I'm social media as well. Mark_Baltazar or at Peak Multifamily. Both accounts have a lot of stuff and information there. Yeah, the website will have a lot of, info, frequently asked question documents, or an overview of the fund. Just enter your contact information there, and then you'll get stuff.
Awesome. Mark, again, thanks for coming by. It was fun.
Yeah, it's good. Thank you.
I appreciate learning from you, and hopefully I'll be where you are in a couple of years.
Yeah, there's just steps to take, right?
Yeah. Take action.
Take action.
Yeah.
Yeah. Cool.
Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember, our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.